Let's talk with Jim. Jim, you're with Allworth Money Matters.
Good. Good morning.
All right.
Morning.
How are you guys?
Good.
Fantastic.
Good. What can we do to help?
I am calling. I would like a bit of your advice or direction on long-term care planning.
Okay.
Whether or not to buy long-term care insurance or not.
And how old are you?
I am 55 years old, and my wife is 57.
Okay.
And
what are your
would you
thoughts?
like me to?
Yeah.
Yeah. So, well, my thought is that I tend to think more that I should self-insure.
Okay.
I got a quote.
Okay, good.
From I actually got like the whole life type quote, and then the term life type quote.
Let us know what these are, because long-term care insurance premiums have gone through the roof the last decade.
Pure long-term care.
Yeah.
Okay. So
But there are long-term care policies embedded in life insurance policies that may or may not make sense.
Okay. So this was a whole life type of. I call it the whole life because you know what I'm talking about.
Yep.
So it was $130,000 premium. The immediate benefit was $333,000 lifetime shared between my spouse and I, and it paid $5,000 a month.
Okay.
It escalated, guaranteed, on both the lifetime benefit and the monthly benefit at 3% annually.
But it's $330,000 lifetime cap.
Yeah, and $130,000 premium at a 55-year-old. Okay, keep going.
Correct. And then it was a 3-month retention.
Okay.
And once you hit the 3-month, then once you went past your 90 days, you got the
benefits.
It went back to the first day, and it was a cash policy, so you didn't actually have to be in a facility. It was as long as you qualified 2 out of 5 of the daily living that you couldn't get, they paid you the check. Right.
Okay,
so
that was my next question.
Okay. And then in the presentation, of course, they're going to show you out at, tapping the benefit at 75 or 80 or whatever, that type of thing, right? So you're like, hey, at this point you're at $12,000 a month and you have a $900,000 benefit.
Okay, because of the 3% increase.
But is that $330,000 lifetime cap? Does that also have a 3% inflation increase?
Okay.
Yes. Yep.
Okay.
Yep. So that's how it got to that.
Good. Before you said that, I'm thinking this thing's a garbage plan.
Okay.
Yeah. Right. Yeah.
I haven't ran the numbers, but I'm just kind of in my head.
All right. And then, so keep going. I love the fact that you started with self-insure versus pay someone else to take the risk, because that's what the question is. That's what you're trying to figure out is, do I pay to push this risk to someone else, or I keep it all in-house?
That's
right. Okay, so give us the other scenario.
Okay, so then what became relevant to me was, okay, well, what's my current financial status? What's my projected financial status? What's my burn rate in retirement, right? And then that kind of dictates, right?
That's right.
Okay, so here's where I'm at today. My wife works in the school district, so she's got a pension that comes. And as far as assets, we have in qualified plans, 401ks, et cetera, $2.8 million. In brokerage accounts, we have $2.5 million. We have a little over $600,000 in cash. We have a primary home that's worth 1.3. We owe 500 on it. We have a rental that's worth about 800 that's free and clear, and we have another rental that's worth about 550 that has a $200,000 mortgage on it.
What's the value of the first? What's the value of the first rental?
The first rental is $800,000.
Okay. And you said the value of your home was how much?
1.3.
Okay.
And are you working today?
$500,000 mortgage. Yes.
And what's your family income?
So I'm self-employed. I own a consulting firm, and so it kind of fluctuates around. Last couple years, about $600,000 or $700,000.
And how much longer do you plan on working?
Well, that's the age-old question that you guys have kind of already at least in some part, made a decision on in terms of how you're exiting your business, right?
Yes.
And so what I have is I own a consulting company where I work for wireless carriers. And so I have all these contracts that are very difficult to get with very large clients.
Yep. You locate your site locator?
Yeah.
Okay.
Yep. And then we do the A&E side of this. So my background as an attorney, I got into this post the global financial crisis and was fortunate enough to turn it into.
You enjoy what you're doing?
Business. Yeah, I do. There's always clients are great, as you guys know, and sometimes clients are a bummer.
You can say that about everything in life.
All right.
Exactly right.
So you're
sometimes my marriage is great, and sometimes it's
for a consultancy firm. You're in a really good position because this is actually something that you could sell for multiples of revenue. In fact, I have a client that sold one. If I gave you his name, you'd know who he was, but I'm not going to do that.
Okay.
And he had built it up he had like 30 or 40 employees, and he sold it to the second generation. So for multiples of revenue. So
here's you have enough assets to sell. So you got roughly $7 million. A 4% distribution rate's $280,000.
And you're only 55.
So if both you and your wife required long-term care today, your estate, $280,000 would be enough to cover it. If you wanted 24-hour in-home care, maybe it'd be a little bit more than that, but you could still go decades before you blew through all your cash.
And the way to think about these policies is because of that $130,000, if it generated 5% returns, that's $6,500 a year. The way these policies are structured is they take that interest off that because you don't see that cash value ever increasing, right? It stays the same. And they use the first $130,000 to pay that $330,000 lifetime benefit. So you're really only getting $200,000 of benefit, of which you're paying $6,500 a year for, which is a 5% return on that $130,000.
I want to make sure that we're on the same page on that one piece. So on this particular quote that I was given, both the monthly pay and the total lifetime benefit increase.
No, I understand that.
Annually.
Understand that.
Okay, good.
I understand that. But the way they're actually paying for it internally, because they have a cost associated with that pure insurance side, which is if you go into a long-term care facility,
they got to pay it out.
They have to pay it out.
Right.
How do they pay that? Well, they actually just don't pay you any interest on the $130,000 that you're putting in the account.
Yes.
And that's your deductible, if you will. So if you die and never use any of the benefits, well, then you get your $130,000 back. But if you use any of the benefits, that actually comes right off there. So the $130,000 is a prepaid deductible with a refundant option on it,
essentially,
and the excess income that it earns, of the 5%, we're just using a market rate, 5% would be equivalent of $6,500 a year, right? And that $6,500 is right now paying for the $200,000 of pure insurance. That's the way.
Right.
You've got a mind for numbers in the locality. So as they're setting aside their reserve on the other side, you look at it and say, well, how are they doing this? And this is how they're doing it. If you think about it from their economics, I don't think you have any reason to buy any insurance.
Here's what I don't like about this: the lifetime cap, $330,000.
But
you've got seven, not counting your home, you have about roughly $7 million of investment.
And he's 55.
What's 300? It's 200. The delta is $200,000. So you're buying $200,000 worth of insurance.
Yeah, you have no need for this. You're 55, and you're in your prime earning years, right? All that education, all those days in law school, all that stuff. This is it. I mean, this between now and the age of 65, you will earn more money in this 10-year period than you probably have your whole lifetime. You're in your prime. You've got the intelligence. You've got the emotional intelligence. You got the focus. You got the relationships.
If this policy had a lifetime benefit, that'd be one thing, because that's
it does have a lifetime benefit. It does have a lifetime benefit.
It's capped.
Yeah, well, it's capped, but the cap increases
Okay.
by 3%.
Yeah,
a year,
understand.
right?
Understand.
But still,
But we're still. I'm with you guys, right? Like
Yeah.
it's no matter. I can't help but think of it like a businessman, right? Like,
That's right.
okay, well,
of course.
I'm not a fan of whole life. That whole sort. Yes, there's a certain position at a certain type of estate and value and all that stuff where that stuff can play in. But for the normal person, term life, right, and invest
Agreed.
those balance of those dollars is the way to go, right? So I can't help but think of it when I look at these two policies.
They don't. Here's the risk. A risk isn't a short-term stay that's going to cost $330,000. The risk is you have some strange health occurrence, and now someone needs to take care of you for the next 25 years.
Yeah.
This policy does not solve that.
But
that's right. That's right.
And Jim, if you came back and your net worth was $1.5 million, I'd probably say, yeah, this isn't a bad deal for you.
Mm-hmm.
Or if you're like, I really would feel really good about having it,
then do it.
Buy it.
But
I don't own one.
But the economics behind it says you don't need it. These are the true cost. It does have the 3%, but if we can only look at it today, what's the cost of this? The cost today is $6,500 a year for $200,000 worth of benefit. At your age and your wife's age of 55 and 57. The insurance company says, hey, they're not going to really need this actuarially based on morbidity tables till they're 75, right?
Right.
So we're at 20 years. For your wife, we're at 18 years at $6,500 a year at current rates, right? You do the math.
Yep.
It's $100,000.
Yeah. Oh, I did it. No,
Okay.
I took what I did is I just took the 130, right? Because I could just take that out of my cash. How would I pay the insurance company? Well, I'd pay it out of my cash, right? So I take that, I go put that in the S&P 500, 25 years, it's $1.3 million or $1.4 million or something like that, with a 10% return, 8%, it's like 900, right?
That's right.
So the only thing I'm dealing with is some tax issues if I withdraw it.
Yeah, but then you use direct indexing and don't worry about it. But your point is exactly taken, which is you're buying $200,000 worth of benefit. You can easily self-insure. Easily.
Yeah. Okay.
Easily.
Yeah. Agreed.
I mean, by the time you go to retire, your net worth will be, let's say you work till you're age 60. If you sell the business, your net worth is probably north of $12 million.
Yeah.
Right?
Yeah.
You did the projections.
Without even selling the, I mean,
You did the projections. So.
And the risk is something happens to you or your wife today that requires a 25-year stay and full care, and this policy does not solve for that.
Yeah.
That's right. Yeah, I like that thinking. That it doesn't take care of the short term.
Yeah, you don't need. You can fund a short term. Frankly, you can fund a long term. You could fund a 25-year one. So
but you're insured for something that. All right, we answered that question. But on a personal basis, Scott and I own a couple commercial properties. If you want to contact me and put a cell tower, I am 100% open
for
to
the
it.
right price. You can put it in my backyard.
Right.
I don't know how the neighbors will like it, but.
They won't like it, but I do have to tell you, I listened to the show when that gentleman that called up with the contract, that he had a cell tower on his property, and he had an offer to sell it. Your guys' advice was to sell it, and
was that bad advice?
No,
okay.
it wasn't bad advice. It was interesting for it to show up that and so tied into what I know and do, right?
Oh yeah,
I've dealt with lots of owners who sold off, and I actually, frankly, through the years, have had numerous landlords ask me my opinion on them, right? And I'm always kind of like,
it's all personal needs.
Myself, right?
It's all their own personal needs.
Exact 100%. And I'll just add a little bit of relevancy to this comment, because here recently, due to the Elon Musk fighting or wanting spectrum that was owned by Dish Wireless, he managed to get Charlie to tap out of the business and sold off all of his spectrum, $17 billion of it worth to AT&T and $17 billion to SpaceX, right?
Yep.
So if you had that tower with that dish lease that you thought just got your bump that you're going to have for X, it's now gone, right? So
Yeah, exactly. And
Interesting.
And by the way, on these my buildings where you put these towers, you don't have to disguise them as trees or water or what do they do on Highway 80 down from Sacramento to San Francisco? They disguise them as water towers or.
Yeah, sure. Yeah, they do that. Yeah.
Oh, I haven't noticed
No,
that.
I like
you
the
can't
man
even
who-
tell them.
I like the man who just wants the cash. Doesn't.
That is.
Oh, Pat says that now.
No. If you disguise it as a tree, you could put it in Scott's backyard. So I appreciate the call.
Thanks, Jim. Wish you well.
Thank you very much. Have a great day.
Yeah, I think about insurance. Like we all have insurance for a variety of purposes, and insurance costs have gone up dramatically on auto, home, just lots of different areas. Insurance costs have gone up for multiple reasons that we're not going to get into. But I like to think about, what do I want to self-insure, and what do I want like my homeowner's insurance? I get the largest deductible I can. Some years it's been $50,000, that high, and it depends on the policy and trying to renew it and that sort of stuff.
But a big umbrella too.
But so first of all, I get a really large deductible because I'm thinking, I get something small happens, I'm not going to bother filing a claim. For one thing, it's just going to make my insurance premiums go up because now I've got a claim on the house. So, like, same thing with my automobile. I think I have a $5,000 deductible.
You keep
and
the
my
risk-
daughter was in an accident. And the collision place said something about, oh, it's too bad you have such a high deductible. I'm thinking, oh, maybe for this year.
Yeah, that's right.
If I look at my whole life, I think I'm saving money. I know I'm saving money because I know how insurance works. But things like an umbrella policy, that you brought up, Pat, a liability, like
That's a big claim.
the larger your estate, the more liability coverage you should have, just an umbrella policy.
Yeah, if you get sued, one of the first things an attorney does an asset search on you. It's like, is this guy worth being sued?
Yeah, because if there's no money, they're not going to bother.
Yeah, if there's no coverage, you can't get blood out of a stone. So, anyway, so back to these cellular towers. My wife and I were driving down to the San Francisco Bay Area, and I pointed one out to her.
I haven't noticed the water towers.
And I said, that's a cellular. And she said, there's no way that's a cellular. I said, no, it's a cellular
Isn't
tower.
that funny? It's just because what people are comfortable with and used to that, because
Yeah.
every town, essentially,
Well, you
flat
don't-
towns had water towers.
Well, because you didn't have electric pumps to create this. And I said, no one's building brand new water towers. Farmers out there are like, oh, we should build a water tower. They're not doing it. So, and I shouldn't say that. Some municipalities do it in order to ensure their water supply because gravity works, whether the electricity is on or off. That's a weird thing about gravity.
Thank you for sharing your knowledge of the water distribution. I'm going to start looking now for water towers. Which ones are phony?
Yeah.
There we go.
Good
All right.
times. Good times.
I love little businesses like that, though. I'd love to actually talk to him more about his business. I always find it fascinating. There are so many little businesses. That's why when you talk, people like you've heard the show long enough, say, don't come to someone like us to get wealthy. Wealth is created in your career. Either you're really great at something, or you start a business, or you're lucky enough to work for a company that goes through the roof, right?
That's it. Or you marry it or you inherit it.
I mean, those, yeah.
But even when you marry it, it's not really yours. So.
But there's lots of little businesses like that.
Highly profitable.
That are really profitable.
Which, by the way, private equity is rolling those up. So
they roll up everything.
everything. Pool services,
Yes.
lawn services, and pest services. Our pest guy just got sold to a private equity firm.
I've done quite a bit of research in this area because of the book that I'm working on.
Yes.
Yeah.
Yeah. And what other industries?
Every industry you can imagine. Anything that has recurring revenue.
And Scott, so tell us about the book you're working on.
The title of the book is
The working title, or you think it's the final?
I actually just last night I was with Forbes Books. I got the final manuscript. It's been all copy edited and everything, and I've got to do the final sign off.
Really?
Got
You're
that?
that
Yeah.
far along?
Yeah,
Well, thanks for sharing.
but it's not going to come out till next year.
Can
'Cause
I
I-
read it before it comes out?
Well, if you're nice. Yeah. The private equity advantage, balancing price, terms, and legacy when selling your business. And it's designed for all these smaller businesses. No one gets out of here alive. So either someone who owns a business chooses their own succession or someone else is going to choose it for them, right? And there's so much private equity cash the industry right now. I mean, floating around in every industry, that there's a lot of consolidation, and people need to make wise choices. So the book is essentially all the things one must consider when selling either to private equity or private equity backed firm. And
you interview people that have sold.
I interviewed a bunch of people and did research on the various industries, and it's things such like, how do you design the terms?
Like, how many years do they pay you out over?
Because there's always that kind of adage that a buyer will pay any price you want if they can control the terms. I'll give you $1 billion for your business if I don't have to pay it in 100 years.
Yeah, yes,
Right? So
yeah, right.
Take it to an extreme.
And I take a portion of the income and then I give it back to you.
There's just a lot of moving parts. How do you hire an investment banker or a broker to help your business? How do you think about the taxes? How do you design the deal? How do you know when it's the right time? What's the difference between selling to private equity versus a firm that's backed by private equity? When does a strategic buyer make more sense?
And why you should or shouldn't sell to internal? You touch on that?
Touch a little on that, yeah. Because yeah.
I'm looking forward to it.
Well, good.
Looking forward to it. Why didn't you interview me for the book?
I've been interviewing you for 30 years. I know your thoughts.
I kind of feel disappointed now.
No, it's been a fun project because, as I think a lot of people know, Allworth, a lot of our growth has come through finding firms to partner with us. So
how many?
40 some odd firms have joined us, which is the best way for us to find talent. That's why we've got such great advisors.
Yeah,
because the people that partner with us.
Yeah, and to grow your own, but it takes a while to grow an advisor.
And it's one of these, like so many industries right now, that just things could be done better if there's a large firm. Even these little pest companies, a lot of them could be just operated better.
Yes, more systems
with
designed,
good systems in place.
and economies of scale.
Yeah. Anyway,
all right.